delivering faster payments and better experiences. So we'll give everyone a few moments to get ready here and join the session. All right. All right. So my name is Ariel German. I'm an engineering manager on our payments engineering team, and I'll be your host for today. Today, joining me are two people who have seen more about payments ledgers than anyone should probably have, Ani Narayan and Henry Hilton. Ani will be joining us shortly, who's our product lead for emerging payment rails, and Henry leads our sales engineering team. A couple of housekeeping items to cover. First, today's session would be recorded and we'll share it afterwards. And second, this is meant to be an interactive session. If you have any questions, hit the Q&A tab at the top bottom of your screen. We'll tackle questions throughout, and if we miss your question, we'll reach to it afterwards. All right, now let's dive right in. So we do something here at Modern Treasury where we like to start chats with sharing our food hot takes. It's a deliberately controversial food opinion, and I'll start with mine. So my food hot take is stuffed crust pizza is very overrated. I see it marketed all the time, but I feel like if we're gonna just buy cheese sticks, it's yeah. How about yours, Henry?
Ariel, I'm with you on that one, man. I am very much of the opinion that it's New York thin style crust or deep dish, and if you want stuffed crust, you should buy some hot sticks on the side. Absolutely. My hot take is the best way to eat a bell pepper is actually like an apple, straight off the core. Just take a big bite out of it. I like it because you can take it on the go, and I think of a bell pepper on the go kind of like packing a protein bar, but for the salad category.
That's a good one.
Ani, pass to you for your food hot take.
All right. I'm Ani. I'm a product lead here at Modern Treasury on new and emerging payment rails. Food hot take is that shoestring fries are the best fries just because they're the most crispy. Just enough surface area to get the most crisp to taste ratio. And if you're not eating crispy fries, why are you eating fries?
Cool. All right. I want to say there are two hot takes, but I've never thought about eating a bell pepper like an apple. And yeah, who doesn't like fries? Cool. So now we've broken the ice a little bit. Let's get started. Ani, maybe we start with you. You've led the charge for emerging payment rails from FedNow to RTP and stablecoin. Can you give us a brief highlight of the payment rails and how they're being used today?
Yeah, absolutely. So let me start with FedNow and RTP, and then we can talk about stablecoins after that. FedNow came live 2 years ago, and RTP was, of course, live much before that, through a lot of work from the Federal Reserve and the TCH. And over these past few years, we have gotten significant coverage across the banks for support on these payment rails. So specifically across both FedNow and RTP, about 85% of banks today support the ability to do payments on both those rails. And we're seeing great adoption from our customers across a variety of use cases in using these payment rails. Particularly, they unlock new use cases, new experiences that they're able to provide to their customers, just better reconciliation and payment operations on all of the traditional, compared to the traditional payment rails, and allow them to do payments 24/7 and over weekends. So it's been tremendously helpful to customers as they think about modernizing their payments infrastructure stack. And we are now currently at Modern Treasury, through our customers, moving over $2 billion annually on these instant payment rails. So significant adoption for an emerging payment rail from the Federal Reserve and TCH. Now that's specifically on your traditional sort of what people might these days call fiat money movement. We've also now seen the advent of stablecoins, and it is growing significantly, not just in the US, but also internationally. And that unlocks a variety of new use cases just because it's not beholden to a traditional banking system and can now just be done with blockchain. And we're seeing several use cases that are now being able to come live as a function of stablecoins. At the end of the day, what is a stablecoin? It is a digital access or digital version of a US dollar that can be transacted on the blockchain globally. And what this does now is many things. One, it allows customers or users internationally to now access US dollars without needing US dollar bank accounts. And we're seeing really good adoption from customers who want to be able to provide access to that. Two, it allows you to do payments instantly 24/7 without being beholden to bank hours. And now you can take that and not just be limited to one geography, but take that internationally and do it cross-border as well. So now you have cross-border payments that are live and instant. And then you can extend that to say, well, because I'm holding a US dollar, I now have access to yield. So it provides these new capabilities for fintechs or any other company to be able to either modernize their own internal payments infrastructure, manage global treasury more efficiently, or pay out their vendors or do payroll more effectively, but also create new user experiences and build fintech products like card issuing or neobanks or digital wallets in a global way from day one without being restricted to requiring local banking licenses internationally or to be able to set up banking relationships everywhere. So it provides this platform upon which you can build great payment experiences beyond the payment rail itself. So overall, we're seeing tremendous adoption across both. And I think there's real magic that gets unlocked when you merge them together. So where you get to on-ramp via RTP and FedNow, do a cross-border transfer to a different country, and then off-ramp to local fiat accounts via the local RTP equivalent. So in the UK, it might be the faster payment method. So end-to-end, you can send a US dollar to a British pound with FX involved over a weekend, which was not possible before using both these instant payment rails. I'll pause there. I know, Henry, you've been working really closely with customers on different use cases and bringing them live. So I would love to hear more about that.
Yeah, absolutely. So thanks for the intro, Ani. What I want to start with is some use cases around real-time payments in the US, and then we'll move to some of these cross-border stablecoin sandwich international FX use cases. First off, for use cases within the US, of course, there's the faster payout through RTP. You get the huge benefit of it being instant, of it being 24/7, clearing on weekends, and also of it being irrevocable. So some of our customers like Stewart Title are very excited about this because they're in a world where they're a 100-plus-year-old company and they have been settling with wires. They have been able to track and close a home on the weekend. So you're actually opening 2 more business days with this new rail that they weren't able to access before. When things settle quickly in a high stress, very emotionally loaded, high value transaction, often the largest transaction of someone's life, waiting 30, 45 minutes in a room, refreshing a wire portal to see if it cleared is a very stressful and not perfect customer experience. So the faster those clear, the better the customer experience and the more competitive a product a 100-year-old company like Stewart can offer. That's why they put it on their roadmap and are building towards that future. Additionally, there are other interesting smaller use cases that can be applied. So one of our customers is a company called Built Rewards. They're the fastest growing new rewards network in the country. They innovated by creating a credit card that lets you pay your rent and earn points. But they also have a huge volume of traditional ACH flows. They're now the fastest growing rent processor for the major corporate property management companies in the US. And as part of that, they have to onboard a ton of bank accounts, right? Just for regular ACH. And they have such high volume consumer scale of account onboarding that they basically need to get the entire surface area of as many methods as possible for trying to onboard and verify that account as they possibly can. So of course they leverage things like Plaid that do bank logins and do direct connectivity to grab and verify consumer bank accounts. But in some cases, for some regional banks, or just for various high volume consumer technical reasons, the Plaid onboarding flow won't work and they have to collect manually. Or people opt out, they actually aren't comfortable logging in with their banking and routing details to something like Plaid. In those cases, they still need to collect banking routing details manually and verify those accounts. So many of us have been through this flow, this sort of legacy flow of the micro deposit verification. You log into an app, You give your account routing number. They send you 2 tiny payments. Usually they're ACH payments. You have to wait, best case, to the next day and remember that you opened this thread, that you started this onboarding on a Tuesday afternoon and you have to come back on Wednesday or Thursday to finish that onboarding. I personally have started this flow many times and forgotten about it and then had to come back the next week and hope that, that I can still find those in my bank statement. That's not a great customer experience because you want to get something like that onboarding, that admin homework done right in one sitting when you've allocated the time for it. So what Built unlocked with us is actually using real-time payments for those micro deposit verification flows. And what that looks like is the moment that someone declines a Plaid flow in their user onboarding, they send them to a micro deposit, send real-time payments right away. So yes, the consumer still has to go over to their banking app, but they can do it right there in the same setting, no matter whether they're doing this on a weekend, like many customers who, many people are handling their rent payment and their admin on a Sunday, right? And they go back to work on Monday. And so they can finish that all on a Sunday, finish their onboarding. They can do it on the 31st before their rent is due on the 1st without suffering any late fees or causing any headache for the property manager or for Built. So solves a huge problem here and a gap in their user onboarding flows for that last 5 or 10% of consumers that can't go through Plaid. What I prepared here is actually a very short demo of what it looks like to bring that in user onboarding.
Henry, just to add to that real quick, that micro deposit use case, incredibly powerful, but even more so in the enterprise. So if you're onboarding an enterprise customer to your app or your product, like say an accounting software or a tax software tool, or CRM or ERP, where you need them to connect your bank accounts, they're often not going to have access to the credentials to put it in via Plaid, or these tools may not necessarily work as well for enterprise bank accounts. So if you're having a head of accounting or just an accountant at those companies wanting to onboard to your application, using micro deposits is a much better way to be able to onboard them without getting access to their bank accounts, which they're less likely to give you access to via Plaid and other tools.
Yeah, absolutely. It's a great point. The case in which Plaid doesn't work for a consumer-focused app like Built is actually 100% of the case for enterprise tools, where many enterprises or B2B use cases are not at all comfortable with sharing something like a bank account username and password log. Yeah. Okay, let me share my screen and let's pop into a quick demo here that shows what this looks like to bring to life. So here we have a fake application called PayFriend. And they're sending a user through an onboarding flow. The user already declined Plaid, and so what they would see is something where they pop into a screen like this, where you're asked for your checking, account, and routing number so that you can be onboarded here. All this what you're about to see is mocked, so none of this is actually live. We're just going to go through what it might look like to run through this flow. And these are the kind of flows that our customers are building directly into their application using our API under the hood to take these actions. So our customer PayFriend may have this screen, and when we click continue here, what we're doing under the hood is creating a new counterparty for paying or charging here in the Modern Treasury application. This is a call to our API to create this counterparty. Of course, this is mocked, but what we can do here is actually send an instant micro deposit verification flow. Again, these aren't real bank account details here, so we've abstracted those away. But what we can do here is then initiate a verification. What that does is it sends 2 tiny verification deposits here to that bank account. And then you can be sent into a screen where you come back and are asked for those amounts. Maybe call them, it's 42 cents and 12 cents here. When you submit that, we actually verify that with our API. And that will give you an instant approval and verification of the account. Here, I went through this flow in, 20 seconds. And that is something that is now possible using real-time payments in the US, when you would have had to break this flow up into 2 parts that wait for days instead for the ACH to settle. So I actually would love to ask Ariel at this point, you spent a lot of time building to these actual systems at the banks. What does it look like to build to real-time systems versus some of the more legacy batch or file-based systems? And how did we at Modern Treasury make sure that we're normalizing across all of that so we can optimize for legacy files, batches, and also these real-time, more API-driven flows?
So I've worked with enterprises setting up payments across, like you said, ACH, wires, RTP. And what stands out about RTP and the faster payment rails is how they force you to think differently. So things like latency suddenly matters a lot more. How you need to, Ani and I have worked on like RTP fallback between different rails, and even the question around when to retry a payment, whether it's Modern Treasury or it's the customer. Those changes, the question changes depending on the rail. So at Modern Treasury, we've as an engineer on the payments team, we just have to go into each individual project thinking very closely around the use cases that are going to be on these rails, figuring out what things we can abstract, but then also acknowledge that we can't abstract everything away from all these different rails. We can definitely look at stablecoins and faster payments and RTP as things that are moving quicker and bucket those together, but not necessarily treat them as if they're going to be like ACH, where you need to worry about things being processed in batches and pending. So that's how kind of my team thinks about it. So now that we are seeing stablecoin introduce another dimension with like wallets, they also open up a new way of thinking about money movement. So from an architecture perspective, could you share more on how Modern Treasury's ledger for faster rails, like what customers are thinking about for stablecoins on the blockchain, and how you think about it on the ledger?
Yeah, absolutely. So historically, any company that's wanted to move money on behalf of their customers have always needed a ledger. They've either bought a ledger or they've built a ledger. We've talked to many customers over the years, large public companies, that have had 6 or 7 different ledgers within their companies that have always never really scaled, have never really talked to each other. Anytime they need to go build a new product, have to go spin up a new team to go create and manage a new ledger. But that has always been the case with traditional sort of money movement. Now, in the world of stablecoins and crypto money movement, you've got another ledger that you need to manage and view, and that is the blockchain ledger. That is your source of truth on how transactions are settling, as well as a wallet balances itself. So one of the questions that we often get asked from customers is, how should I be thinking about internal ledger design when I've got the blockchain? Like, is that sufficient? Will I be able to use that instead of needing to build or buy a ledger and use that as well? Well, the answer is, what you need internally is one core source of truth for your money movement and your balances for your customers. And that's often not within the blockchain, because that doesn't have all of the context of the non-crypto money movement. And that is where sort of a traditional ledger, a double entry ledger, think of it as a database, is very important. So at Modern Treasury, we spent years building and scaling a really performant ledger for a variety of different use cases. And when you're architecting this, you need that ledger to be able to track fiat balances and transactions, crypto balances and transactions across your accounts, as well as your individual user accounts, and have that as a real-time source of truth when you're on-ramping or off-ramping, to be able to, in a high throughput, low latency way, be able to update the latest state of the world for your customers, and always have that be the source of truth. But beyond just tracking balances, what you also need to do is often issue a card for your customers to be able to spend down either fiat or stable coins. And when you need to, where that card swipe happens, that often needs to do a balance check. And that needs to be done in real time in an incredibly low latency way across the world internationally. And that is where our ledger really shines as well. You need your ledger to be performant and scaled enough to be able to handle that use case as well. So across the board, it's not mutually exclusive that a blockchain ledger alone will be sufficient, where you'll actually need a holistic, unified source of truth for all your money movement. And even practically, if you were to just be a crypto native company, and let's say you were issuing a card, if you had to go in and query on the blockchain at every single time for a user balance in order to be able to determine whether that card swipe is going to work or not, that may not be performant enough for that real-time transaction, which is where you want to have that separate ledger, both from a redundancy perspective, but also from a performance perspective.
What I would add there additionally to is that every company, even if they are a crypto native company, is going to have some transactions in fiat as well. That's probably the on-ramp or the off-ramp to that crypto transaction. And in those cases, it's really important to lay your fiat transactions right next to your crypto transactions as well. Ideally, recording both in something like double entry accounting, a best practice, so they can roll up to the correct debit and credit entries that are journaled to an ERP or general ledger at the end of the month. All of that then needs to be productized into your application. And so it needs to be, I thought I was mentioning, performant enough to go and deliver a user experience like servicing wallet balances of your crypto balance right next to your fiat balance in a user application.
Yeah, and absolutely. One of the other things that I often think about is as we get into the world of doing FX on ledgers, on stablecoins and generally fiat across different countries, tracking that is going to be particularly complex. And that is where you would need a ledger as well to be able to manage different exchange rates for accounting purposes as well.
And we'll dive right into that shortly. But thanks, Ani, and thanks, Henry. I want to take a quick thank you for the perspectives, and just a quick reminder to everyone who's watching: please use the Q&A box if there's something that you'd like us to dig into. We want this session to be as useful as possible for everyone. Tiani, we talked about architecture, we talked about ledger. When you think about cross-border payments, what should customers be thinking about?
Yeah, absolutely. We touched about it briefly with ledger, right? But overall, with stablecoins, it now unlocks a new dimension of cross-border payments beyond the world of SWIFT or third-party payment processors that would either do netting before or do money movement over bank rails like Global ACH. You've now got this new powerful capability where, at the very least, you can move money internationally over stablecoins itself. So it's just a stablecoin transfer. Yes, you have to manage the different chains. You might need to bridge to different stablecoins itself, but all of that can potentially happen on the blockchain if your counterparty is willing to receive and manage stablecoins itself. Great. Now, let's take that one step further. What if they wanted to receive fiat instead into their bank accounts and they're not stablecoin native? They don't have wallets. You don't want them to manage all of that. Well, now you have the ability to use what folks call the stablecoin sandwich and be able to work with local off-ramp vendors, providers, to build a network where you would send them and deposit stablecoins, and they would convert that via local capital pools into local currency and deliver that via the local payment methods to your counterparty's bank accounts. And that now unlocks this 24/7 cross-border payment method that we talked about, which is really powerful. Now, that is at varying levels of coverage and availability today. It is widely available, at least within the T1s, as well as regions like LATAM and Africa. But the FX rates particularly vary, where the tier ones may not necessarily be as optimized as what you might be able to get with a bank, as an example. But with the tier 2 and tier 3 corridors, or what folks call the exotic corridors, you have the ability to potentially access much more favorable FX rates compared to what you might get with another provider. So that really varies on a corridor-to-corridor basis, and that's something to think about as you consider your overall holistic strategy on global payments. And beyond that, I think the vision for the future is when you can have on-chain FX, where today 99% of all stablecoin transactions are done over US dollar-denominated stablecoins. But in the future, when you have other currencies also have their equivalents on the blockchain, so take a GBP stablecoin or a Euro stablecoin, and now you're doing transactions on the blockchain, you're doing FX transactions there, that unlocks a whole new world of potential efficiencies, more competitive FX rates, faster payment delivery internationally. And that is a really exciting world. So that is something to look forward to down the line. But today, stablecoins in itself has unlocked this incredible set of capabilities. One example, or I'll walk you all through two examples where, one is more stablecoin native and the other one's a sandwich model. For example, we've got companies that need to pay global contractors across a variety of different countries, particularly in countries where currency fluctuation is massive, particularly devalued, and they want to access US dollars instead of the local currency. And we've seen companies like Scale AI be able to pay contractors internationally using stablecoins itself, and that's what their counterparties prefer to receive. And then we've got payroll companies today that want to do cross-border transfers for gig wage workers, or for managing global payroll. And one of the problems that they come to us with and say that when I use a bank or when I use a payment provider, they're great, the payments deliver, but oftentimes I don't have the visibility, or oftentimes I don't have guarantees of timeline on when the payment is going to deliver, which is particularly important for me as a payroll company where people are reliant on that payment coming through maybe every 2 Fridays or whatever. And there's also legal risk if I were to miss that timeline. But stablecoins with the sandwich method can offer them the ability to be able to instantly send cross-border payments with confidence of delivery. They can clear within the same hour at the very least, if not much faster, and within 5 to 10 minutes. It can be done over weekends. So in case there's some operational issue or you missed payroll, you can now do that over weekends and cover up. So there's a lot of things that can now be unlocked from a use case perspective across both methods of cross-border transfers, but stablecoins overall are incredibly powerful as a way to do that.
Thanks for sharing, Ani. What I have prepped next is a short example using our same PayFriend application of how customers of ours might actually hold a wallet balance after that RTP account verification onboarding that we looked at, and then use that wallet balance to transact both in US dollar in the US, but then also to transact cross-currency. And we'll use that as a lens to speak to where the stablecoin sandwich comes in as an alternative to traditional cross-border FX bank rails that are quite expensive. So let's jump back into our demo environment here. And so we've got a new screen here within the PayFriend application, remember PayFriend being a customer of Modern Treasury integrated to our APIs. And PayFriend in this case is not just using our payments product to onboard accounts and run the payments in and out of these wallets, but they're also using our ledgering product in order to track and hold balances using the Modern Treasury ledger. So in this case, this ledger balance is actually a live API call directly off of our cloud ledger as a service to pull in this particular user's wallet balance. Now, let's say this user wants to use their balance to pay someone. So if they go to pay, they might have a few different options. First, sending someone money in the US, then sending someone money cross-border in Europe, and finally, if they wanted to send someone Bitcoin with an instant purchase and delivery. So first off, let's take the US option because it's the simplest to anchor our understanding. So a company like PayFriend probably is holding a bank account in the US. Right? They're a US-based company. They maybe have a for benefit of style account, or they have their own money transmitter licenses, or otherwise licensed to hold customer funds in the US. So for them, sending money from this user to Jane is as simple as a single ledger transaction with a $50 debit and a $50 credit. Modern Treasury denominates in cents here to make sure we're at the lowest level. And this actually can be sent as an instant ledger transaction and settle immediately, debiting from one user and crediting to another user. Now think about it this way. The cash is actually still just sitting in PayFriend's pooled account. So this is an instant reallocation, and the customer experience is absolutely instantaneous because this is sort of an on-us ledger-only transaction. That's all well and good until you get to the point where you now need to go cross-border or move to crypto. So if we go to cross-border, we suddenly don't have that option anymore. If we want to send $50 of USD and have Jim receive $46 of euros, we don't have that option of simply moving it, reallocating the ledger within our account. Now we have to go to some external rail or method. The traditional format here would be us using something like an international SWIFT wire, which is very expensive through our bank, or using something like a global ACH style or cross-border payout style product from a bank where they actually embed the FX transaction in and they send it across border with a ACH in the US and then say a SEPA credit out in Europe. These are great options, but they're expensive and pretty slow. So SWIFT can clear in under an hour, but it's quite expensive, up to $25, $30, $50 per wire, which is absolutely out of the question for a use case like this, where we're sending $50 to Europe. The local payment rails are cheaper, ACH in the US, FX into a SEPA credit, but those sometimes are slow. We have to do the ACH debit in the US. We have to have the bank settle that FX trade. Often they're taking a pretty decent take on that FX rate. And then they have to do the payout in Europe, usually after a fraud hold. So maybe it's taking a day or two for this to actually settle to Jim in Europe, if not longer. Now, if we were to apply something like this stablecoin sandwich, how does this work instead? Well, what we do is we immediately buy USDC using this $50. And then what we can do is transact that USDC across border to Europe. We could even swap it to EURC, to euros, to get that FX conversion instantly. And then run the payout in euros on the other side. Now, if the consumer Jim wanted to have this payout be to a euro wallet that is specifically just held in Europe, this transaction could actually happen instantly as well, just like our first example. Of course, we wanted to pay out with a SEPA credit. Maybe we need to wait for that SEPA credit to settle. But let's say we had a correspondent bank, or you're using Modern Treasury for this service. What we could do is actually then do a SEPA instant credit out the other side in Europe. And this whole end-to-end transaction could actually settle just as quickly as that on-us ledger-only transaction that we saw at the start. So the TLDR here is that in this way, using our instant payment rails and then using our double entry ledger to track every side of this transaction, both in USD and euros, we can create experiences for companies like PayFriend that mirror experiences that were only possible within a single currency within the US in the past. And then finally, of course, for companies who do transact in crypto directly, of course, we can support that as well. Specifically on our ledger, we support custom currencies of any amount up to 32 decimal places, which supports use cases like Bitcoin. So what we can do is record a purchase of a Bitcoin with USD, show it being sent across the Bitcoin network, recording that the FX rate or the purchase rate of the Bitcoin, and then ledgering every single part of this, including things like withdrawal fees or network fees that might be part of that flow as well. Our double entry ledger is powerful enough of this. Make sure you're not creating or destroying any money or crypto value as you record these transactions in real time. And it's even more important to ledger all of these things in real time because all these payment rails are happening in real time, right? And so in the end, the Modern Treasury Ledger is the way that we can reliably track our business, keep our product flowing, watch our balances in the user app update, and then track all of that internally as a finance or an operations team as well.
Cool. Henry, one question did come in during your demo from social media. How does it work for the ledger? How does the ledger work with instant payments? I think the question is around, isn't the ledger always going to be slower than the instant payments? And how are we keeping things like the balance, the right balance up to date? Because as you showed, the balance is going to be shown in the app.
Yeah, absolutely. So our Modern Treasury Ledger is actually built to work as fast as the instant payments happen. So the way that our ledger is implemented, and let me actually share a short presentation here. We just got a couple slides that show how it's put together. I'll go right to this one here. So this is a little diagram of where our ledger fits in. The way our customers use our ledger is they take all of the different production events, payment events, including real-time payments or third-party systems like processors or stablecoin providers, and they feed in API calls to our ledger. Our ledger is performant enough to receive all of those events in real time and very quickly with strong write-to-read consistency, recompute balances so they can show back up in your application and in your internal reporting. So if you remember back to our demonstration with PayFriend, as we were making those calls, doing those transfers, sending USD, converting to euros, and sending cross-border, we were decrementing down that in-app balance that's surfaced to the user. And all of that is computed as part of our Modern Treasury Ledger product. All your team has to worry about is feeding in those production events as they occur in real time, and we are performant enough to receive them and automatically cache, scale, shard, and compute on our database all of those balances and roll-up results.
Great, thank you for walking us through that. So this is you showed us a consumer app One question that just came in as well from our audience is, how are enterprises using this for internal treasury management?
That's a great question. So we support enterprises today to manage their treasury internally over traditional payment rails. And we've seen how inefficient that can be. And that is the conversation that we're having with a lot of them. Where think about companies, especially when they're global, they tend to have bank accounts internationally in several different countries that they need to manage and fund and do payments out of. And that is incredibly inefficient today, where you have to ensure that those accounts are properly funded, say to make local payroll funding or to do other just general business operations out of. And we see customers either forgetting to fund those accounts or underfunding it and now scrambling over weekends to find a way to fund them or to get lines of credit from their local bank partners. And those accounts, apart from the inability to fund them very quickly or in a 24/7 way, those accounts are also zero interest yield bearing. So these no-stro accounts are often available to you, but you're not making any money on the balances that you're holding there. So stablecoins really offer this potential vision for a world where you can manage global treasury without needing to go through the traditional system as it is today, where you can still have those bank accounts. It's really powerful to have those banking relationships if you already have them. But stablecoins now allow you to hold US dollars within your US accounts for much longer. Or you can hold it in stablecoins itself and access yield. But essentially, you can have those assets be yield bearing up until the point in which you need to fund those accounts. So you can fund your accounts internationally in a just-in-time way, and then use stablecoins via the sandwich method to fund those accounts just when you need it, and then make the local payouts to your local counterparties. That is really interesting. And internally, that makes operations significantly more efficient. You don't need to be beholden to global FX exposure, where you're holding local currencies for longer than you want to. And think about the reverse way as well, right? If you're having revenue that you're collecting internationally that you don't want to hold in local currency for very long, now you have the ability to swap into stable coins or digital or dollar equivalents, and either repatriate it, but at the very least hold it in dollars to manage that FX risk. So we certainly see a world in which these tools are available to finance and treasury teams to manage their corporate internal money movement and treasury in a much more efficient way. I think we're early in the adoption cycle of that. So we're having active conversations with companies to be able to do it. On the payments piece is probably what resonates the most. Hey, I need to fund my Singapore bank account. Instead of it currently takes me 2 days, can you do that for me in a day? Like those are conversations that are very interesting right now. But I imagine over the course of the next year, we're going to have a lot more compelling use cases or companies that are truly managing their treasury using stablecoins and international wallets.
Yeah, that's a great perspective. So I work on the engineering team. I see a lot of customers who rely on ACH payments, and earlier I mentioned like using fallback types, and even if you're not using faster payments today, when things happen with the slower payments, you're going to be looking for a faster option. And right now it's wires. Recently it's been more RTP, and I can see stablecoins kind of being one of those options that you want to leverage if you need that quickness in your workflow. Cool. All right. So as we close, just a reminder that we host these tech talks regularly. We also run monthly demos where you can see some of these ideas in action. This session was also recorded if you wanted to go back and see some of the demos that Henry showed. And we'd love for you to join these sessions as well in the future. In the chat, there's the dates for the next talk. Thank you for everyone for joining today's Faster Payments talk, and we'll hope you'll check out all our upcoming tech talks and monthly demos and keep exploring these topics. Thanks, Annie. Thanks, Henry.
Thanks, folks.